Welcome to Season 1 of Margin Talks by Finaloop. Don't forget to subscribe to the show's newsletter for lots of free exclusive, expert-led content in the links below.
We've got Andrew Faris, a dear friend and multidisciplinary e-commerce entrepreneur. Andrew, first of all, welcome.
Thanks, Fan. I'm very happy that you're doing this and very happy that now I don't have to ask you the questions. You can ask me the questions.
Amazing. So to kick things off, I saw our mutual friend and e-commerce celebrity, the Leonardo DiCaprio of e-commerce, Sean Frank, say that 2.5 times ROAS is good for 2024. First question is, do you agree? The follow-up question is, if that's true and you need to spend 40% of net revs on marketing, does e-commerce even work, and what kind of gross margin profile do you need to be at?
I think that the notion of 2.5x is good is a fundamentally flawed idea, because 2.5x ROAS is good depends totally on your business's economics. I'm almost certain that Sean Frank's own business does not run at a 2.5x. I think I've heard him say in a lot of places that he runs his business much hotter than that. I think the whole business is running closer to like a 2 MER or something like that, where he's really trying to deploy as many dollars as possible into customer acquisition. And the reason Sean does that and can do that is really simple, which is that his goals for his business require him to behave that way. So Sean has been very public about the fact that he is trying to build a $1 billion business. He wants to build a $1 billion e-commerce business. Well, if you want to do that, you got to deploy a lot of money in advertising, among other things that you have to do to accomplish that. And it also means that you probably have a product set that you are expecting to make it so that your customers are drastically more valuable to you over time. Where as you release wallets initially, that's a very low LTV product. I know that for a fact. I've run a wallet brand, and it's very low. And so what Sean has done is released backpacks and rings and all these things and built a giant customer base that he's trying to make very loyal to his brand for the sake of building something very, very large. And therefore 2.5x ROAS is bad for him, but it's bad in the other direction than you would think. It's actually too good, I think. I don't know. I don't know Sean well. I've only interacted with him a couple times. And so all of this may have changed in recent things. I'm not up on exactly what's happening in Ridge's business, but that's my sense of what's going on. So the truth is that the other way to think about your ROAS is to think about customers and products as an investment vehicle. And if you think about the return on invested capital on your customers, that sort of every customer you acquire, if you do the sort of annualized returns math on that, it is an incredible investment vehicle relative to other options in most cases. If you think of public markets, certainly an index fund, if you sort of just expect an index fund is going to return 8% per year or whatever, the way, if you start to think about your business that way, where you think about the customers and the products that you make as individual investments, each one of them, then the return on those will look very good. So good, depending on a lot of things in your unit economics, so good, in fact, that stopping at a 2.5x would be crazy. It would be like if somebody told you that, I can close to guarantee you, let's just pull a number out of our hat, a 50% annualized return on your money, and you're at a 2.5, and let's say at a 2.2, it becomes a 35% or 40%. That wouldn't be best in class in e-commerce, and yet still, you would be like, yes, go put money into that investment, right? So the point is, if you just think about those things as a place to deploy capital and turn it into more money, then it becomes a really, really tantalizing thing. So I have clients that run at drastically lower rates than a 2.5 ROAS, and they're not trying to get to a 2.5 ROAS. They would probably fire me if I kept them at a 2.5 ROAS, because I would not be aggressive enough relative to the goals they're trying to create in their business. So there's a lot more you could say about that. In all of it, I think what it gets at is that the actual goal here, and this probably fits with the theme of your podcast well, is to build a P&L strategically. You should have a goal for the outcome of your P&L and be thinking about that 40% number of ad spend that you just mentioned. You should be thinking about that in relation to some kind of intended outcome at the bottom of your P&L. And I don't think I call this P&L design. I don't think people think that way about their P&Ls very often. They think of their P&L as something handed to them, not as something that they design, certainly for things like margin and OpEx and some of those things. And I think they need to think about it like something they design.
So you've got Jacob and Fan here again to click into what we think are the particularly interesting areas of our conversation with our guests. Andrew said one of my favorite things in e-commerce, which is P&L design. I think it's actually one of the most underrated parts of e-commerce. His point being that operators should be very intentional with the major line items in a P&L and shouldn't just assume it's 2 times ROAS because that's what I saw on social media, or it's 15% cost of delivery and I just need to take that. But being very thoughtful about what the makeup of all those lines and how it can work to be a profitable business. So Jacob, my question to you is, how do you advise Finaloop customers on P&L design, and how does Finaloop help them do that?
So the P&L is the profit and loss statement, which may be the most important of the accounting statements. It shows you profit and loss of the company, looking at all the sales and revenue streaming in on the one hand and all of the expenses coming out on the other. And it'll give you all kinds of really important metrics and margins and a bottom line of, am I in a profit or loss position in a given period? P&L can be annual, could be quarterly, could be monthly. If you're using software like Finaloop, it could even be daily. It gives me really good visibility into the company's financial position. Now, just one caveat before getting into what the P&L looks like, it's really important to understand that assuming I'm doing accrual-based accounting, and I should be doing accrual-based accounting, meaning I'm not following when the cash actually leaves or enters my bank account, but when I have an accounting entry that moves either a debit or credit or an expense or income from my books, meaning if I have a prepaid expense, if I have a subscription, let's say like G Suite or anything else I'm using, and I pay a year in advance, then cash left my account today, but I should be recognizing that expense over the period of the year. And I could have deferred revenues, which are the same thing in the opposite direction. So it's really important to note that my P&L is not based on my cash flow and doesn't necessarily correlate with my cash flow. And if I have a really good P&L, I could have absolutely no cash in my bank account because it's all tied up in inventory or in account receivables, and vice versa. I could have a negative P&L, but I could have lots of cash from previous periods, or because I have account payables and I didn't pay my vendors yet. We're going to talk about the cash flow separately, but just important to know that even if you have a good P&L, it doesn't necessarily mean that you have cash in your account. That's number one. Number two, looking at the actual P&L, it's divided into several sections. The first one being the sales section. So I have my gross sales, which is the total amount that I sold in any given period. And then I have my net sales. And in between, I have what reduced my gross sales and turned into my net sales, like refunds, returns, discounts, promotions, etc. So it's really important just to point out, first of all, I should not only be looking at my gross sales line, kind of like, let's say some SaaS companies just want to grow the top line. That's not what's really important. On the other hand, I shouldn't just be looking at my bottom line net sales, because I want to understand the trends and why my gross sales that look like X are turning into net sales that look like a certain percentage of X or Y. Right? I want to know if I'm discounting too heavily in the holiday season, or maybe I'm not discounting enough. I need to discount more to keep up with my competition. I want to know what my refunds and returns look like, especially if I'm in the apparel line of business and those really high refunds or returns. How do I minimize that? I first need to know what they look like. All right. So it's really important to get my gross numbers, my net numbers, and the trends that actually turn the gross into the net sales. Now, below that, I have my various costs. So my first one, being a really heavy one in the e-commerce world, is my COGS, or cost of goods sold. All right, in a lot of non-e-commerce related businesses, just like SaaS, let's say, for example, COGS are pretty much insignificant, but in our line of business, they're super, super important. And it pretty much divides into product and non-product COGS, which are the costs that are going directly into the product to manufacture it. Let's say that's part of my product COGS. If I'm selling cookies and cookie jars, that will be manufacturing those cookies, the cookie jars, shipping in, meaning shipping in from wherever I'm manufacturing it to my final warehouse. Those will all be part of my product COGS, and the expenses will actually be capitalized and only recognized when I sell those cookie jars to third-party customers. And then I'm going to have non-product COGS, which are expensed immediately, which is like my fulfillment fees, which include pick and pack, etc., my shipping out fees, my merchant fees, and all of those will comprise of my COGS. And when I take my net sales and I reduce my COGS from that number, I'm going to be left with my gross margin, gross profit, which could be either be a number or a percentage, which is a really important metric. And I'm going to compare it to other companies in my line of business and just in general with other companies to see exactly where I stand. Now, because ad spend is such a crucial part of e-commerce companies, some like to take my variable marketing spend and that somewhere around that line, usually below the gross margin line, and then below that draw another line and call that the contribution margin. There's different ways of defining it. That's more or less it. My net sales less all of my variable expenses, meaning all of my expenses that will change based on the amount of units that I sell. And then beyond that, I'm going to have my fixed expenses, which include my operating expenses like payroll and paying my employees no matter what, whether I sell or don't sell my products, my rent costs, my fixed marketing costs, depreciation costs, right? If I have a warehouse, I'm not going to recognize the initial purchase cost as an expense immediately, but rather I'll depreciate the value over the lifetime of that warehouse, etc. Third-party costs, if I'm paying various bookkeeping, accounting, legal fees, etc. And then I'm going to have my operating profit or margin, which is my gross less these operating costs. And then my main costs afterwards will usually be interest, which a lot of companies in the e-commerce space end up taking debt, and not the interest portion of those expenses will be included in my P&L, not the principal repayment, just the interest. And after that, I'm going to have my net income before taxes. And if I have taxes, I'll place my various tax expenses. Then I'll have my net after tax profit or loss on the bottom line. So that's kind of more or less a structure of what the P&L looks like.
Excellent. And now back to the episode.
Given that we just inferred that customer cohorts produce potentially higher returns than the S&P, is this when we need to put in a disclaimer? This is not financial advice, and please don't sue us if it didn't work.
Yeah, I don't know. It's not my podcast. Maybe you need to do that.
Yeah. Okay, so insert disclaimer here. Just to pull on that a little bit, I think that I agree on the view of thinking about customers as a investment class. But I think that there's a lot of nuance and, in fact, huge miscalculations, granted at a prior time when maybe this calculation was more correct, on LTV on a revenue basis versus on a margin basis, right? Yeah. And so I think there is just probably 2 to 3x difference on, yes, I can buy this customer for $100, and over next year I will see $200 of revenue LTV versus $200 of contribution margin LTV, right? And I think the revenue LTV in today's market is just much harder to justify. And but I think that that's definitely a mistake that we have tried to correct for ourselves, but also still see being made in today's market.
Well, just to be clear too, I am doing that return on invested capital math in terms of net of margins, which is why I mentioned the product cost in the customer acquisition cost, right? Because if you just do customer acquisition cost, yeah, you're right. You're basically making a revenue calculation, right? The customer costs $100 to acquire today, and then produces $900 in revenue. Well, it doesn't really matter if it's $900 in revenue if the cost of goods on that $900 is another $800. You know, like then now you've broken even over that time period, right? So I think you have to do that math. And in fact, to be totally honest with you, even when I do this math, usually I'm fudging the annualized component of it a little bit because, in fact, future orders come, 6 months, 9 months down the line, whatever. And when that happens, that means that the cost of goods on those also hits your, hits your P&L 6 months, 9 months down the line, or depending on your manufacturing terms and all those things. And therefore, actually, if you annualize those, you've got another year to annualize those out from the COGS in the future. So they actually look even better than what I said, even net of all of those calculations. In any case, what I think you're getting at that's right is you have to build an e-commerce business for profit. The case for doing this on revenue is dead and gone. It's not even close. You can look at this in every possible way. There is no revenue case, revenue-based valuation case in e-commerce, except for maybe the possibility in some respect that it has an outside, building a much larger business has an outsized effect on your multiple. But even that, it's still really a profit calculation. It's not really a revenue calculation. It's just a way of saying it's, anyway, I don't want to go down, you can go down that rabbit hole as far as you want, Fan, but I think either way, this is, one of the seismic shifts in e-commerce, right, is that everybody's building for profit at this point. Everybody is, at least that I know of. I think you've told me you've still talked to plenty of people who don't see the world world that way and maybe aren't as clued into that. Maybe I hang around circles that are a little more, I don't know, sophisticated or something like that. When my friends are like people like you, you're not fooled on that at this point. So yeah, it's definitely different than the world was.
I think the other nuance about kind of that LTV calculation of that customer as an investment clause is something you and I have specifically debated. I remember on our last walk in South Bay, which is, you said, hey, I'm very happy to spend aggressively if there's a long LTV tail, even if it's a over kind of 2 years, let's say. And my pushback at the time, and is still today, is that accounting enough for competition and market saturation? You know, the classic case of like Groupon LTV was really, really great 10 years ago until it wasn't. And everyone either got tired of the novelty or there were other competitive alternatives. I'm curious how you kind of think about competition and customer fatigue eating into LTV.
So I think one of the big myths in LTV calculations in e-commerce is that they're really shaky and they're not reliable. I think that's wrong. I think actually LTV cohorts, like your future LTV cohorts, are very likely to be like your past LTV cohorts, at least to some degree. And I've had this conversation with plenty of clients and other operators and stuff where they go like, okay, we haven't spent aggressively on Facebook before. Our LTV, let's say our LTV is 100% in a year right now, but that's customers who came to us organically. Those are like super customers. They're like super fans. If we acquire Facebook customers, are we sure they're going to be the same way? There's like this idea that Facebook's going to somehow get you crappier customers, and it's wrong. I mean, if it's right, it's not right very much. Like it's like a relatively small difference between those two customer cohorts, and it's probably not right at all, actually. Like in my experience, except for extreme cases of this, like I've seen one brand where their first batch of customers was like from organic influencer relationship, and the influencer was an influencer around some lifestyle things, specifically, you know, in a way where it was like, and the product was directly related to what they influenced on. Those first customers from that were very, very, very sticky. But that's fine. Like we expected that going in, and we knew, you know, it was a reasonable enough thing to where we didn't get crazy on that. But like, you know, I talked to my friend Jack Rubin at Pretty and Fig, which is entirely a subscription-based business. Here's something nobody thinks about. It's possible that your customers actually get better over time, and they get better because you get better at figuring out how to do it. You figure out how to reduce churn. You figure out what offers produce better customers. And so anyway, the actual answer here is to measure it carefully, and then to measure also your finances carefully. Again, this is going to fit nicely with the sponsor and the presenter of what this show is, and that's great. I think Finaloop's great for exactly that reason. Like the actual thing to do here is to make your bet. Don't make a bet that is overly risky relative to the capital you have in the business, and then to measure relentlessly and figure out relentlessly how to do it. The point about the 2-year LTV is actually not that for very many businesses that I would actually push somebody into a 2-year timeline to get their money back or whatever, right? I'm not suggesting that necessarily. In fact, I don't think I've ever said that to a client. What I will say, though, is that almost everybody thinks of year 2, because they all want to make sure they get their money back and start making profit earlier than that. They basically don't even put year 2 or year 3 or something like that of a customer's LTV into their calculation of like what a customer will be worth, and it's all gravy in their business, and sometimes there is a lot of gravy there. That's really all I'm saying. And so much, in fact, that at points it was foolish not to deploy more capital if you have it into acquiring more customers, not really to realize value on a 2-year timeline, but just because like you may actually have wanted to be more aggressive when the getting was good. If I go back to my very first job in e-commerce at Kalo, QALO, you know, silicone wedding rings. They were the first big silicone wedding ring company. The thing we all kick ourselves about was that we didn't invest in Facebook ads more aggressively at the time, and we were investing pretty aggressively. You know, but we just all look at it and we go like, what were we thinking? Like we should have been spending more money growing a bigger business at the time. So there's a lot of ways to do this. Again, it's going to depend on your goals. If you're Sean Frank and you want $1 billion business, you're going to think about this problem really differently than let's say me. My own instinct would be to take more money. I'm not trying to grow that big of a thing. In my case, in my agency, I'm just not pushing very hard on this. But depending on what those goals are and depending on what your capital situation is and some of those things, it's very possible that you should think more broadly about those LTV cohorts. And the real answer here is measure them carefully.
So you have Jacob and Fan here again. Andrew saying something that I love hearing in e-commerce, which is the importance of measuring carefully. This is something that I know Finaloop is very proud of, and is probably the key part of the Finaloop product which is having orderly real-time financials to give the visibility to help their customers measure carefully. What does measure carefully mean to you, Jacob?
Yes, I really just can't stress the importance of financials enough. Right? A lot of people think, a lot of founders, many spaces, that finance is just this boring, less relevant, or it's not the core product. Let's outsource it, a bookkeeping or fractional CFO firm, and I'll be able to deal with my core business. But it's really important to actually be very involved and very on top of your financials, right? Financials are and can be used for regulatory purposes. You need them as a basis for your tax return, and some cases you need the actual financials as well. But it's not just for purposes of regulation and tax. Again, it's important. You need to know what you need to pay or what you are able to get from the tax authority, but there are many, many more things you can do with your financials. So first of all, using them to actually understand and grow your business, right? If you don't really understand your financials, then you're not going to be able to plan your cash flow, your inventory forecasting, your landed costs, knowing your profitability, knowing what you really have and what you owe. You just won't really have any idea of how to manage your business. So if you have really good financials that reflect what your company actually is doing and you understand them, then you can manage and grow your business much, much better, obviously, than if you're just outsourcing it and don't really understand what's going on there. And the last, but definitely not least, is sometimes you need your financials for a third party, right? Meaning not just for your regulatory tax purposes, not just to manage your business, but someone else wants to look under the hood of your business and see what's going on there. We see this all the time with people that come up to us and say, I need help with my financials because I want to take out a loan and the bank wants to see what's going on, or I have a potential angel or venture capital investor, or I'm in the process of an M&A and I can't get that M&A finalized just because my financials are a mess. So if a third party or someone else who is serious and wants to understand what's going on in your business, they're going to want to see your financials. So you don't just need your financials for yourself, but you need them for others. And you should not wait until it's actually necessary to have them, meaning when you're applying for that SBA loan or that other kind of financing, or when the angel investor comes up to you, or you're in the middle of a DD in an M&A process. Because when you prepare financials at the end of that process, first of all, it's going to be very hard to do, just because you have to start finding documents from 4 years ago and old invoices, and you can't find your old bookkeeper, and it's just going to be a mess. And second of all, even if you manage to do it, then it's going to always be taken with a grain of salt, because you're preparing the financials for this specific event, as opposed to if you had really good financials that reflect your financial state for over the past couple of years, and you had them as time progressed and you just show them to this third party, then it'll be taken much more seriously, and they'll actually be able to trust those financials more, and there's a bigger chance that you'll be able to close that deal that you need a third party for.
And back to the episode.
I love that our first deep dive has already taken us 13 minutes.
Sorry.
No, I love it. I love the passion from both sides. For our audience, let's cover 2 minutes of background. Who is Andrew? What are you doing today?
Yeah, so I've been in e-commerce for the last 10 years, and I've been in, I think, just about every seat on the marketing side of e-commerce. I started off on the brand side at Kalo, selling silicone wedding rings as a media buyer. I actually was outside of even Facebook and Google. I was mostly Facebook and Google media buyer in-house, but I did direct media buys with magazines, like print and things like that, which was a waste of money. Don't do that. Yeah, at least if you're a DTC brand. So did that, went over to Common Thread Collective with Taylor Holiday as an ad strategist there, as he was beginning to build that. I was actually the first strategist at CTC besides Taylor himself. So that became the step into trying to grow the agency, where I eventually became the head of that business, VP of growth there, or strategy or something. I don't remember. Like the head of the growth side of the business, not the head of the whole thing. That was Taylor. CTC launched an aggregator called 4x400, which of course is a world you know well fan. and that's how we first started talking, was buying and selling brands for an aggregator. I eventually became the CEO of that. Left that at the end of 21 and into early 22, started freelancing and then building what is now a boutique agency called AJF Growth. I keep 5 managed services clients, put out a podcast, and that's really where I spend most of my time at this point. So I think I've seen it from just about every side, really with a focus on growth marketing the whole way.
And so you just need to start a 3PL and then launch a niche
software SaaS business.
Yeah, niche software service, and then you will have done everything.
The complete set.
Yeah, the complete set, exactly. It's like, it's Thanos and all the rings. Yeah.
I was just talking to a friend today who's building a piece of software for something that I think is pretty cool, and we've kicked around at least getting me on the cap table at some point for it. So maybe I'll let you know if that happens.
Yeah,
I have absolutely no clue how to run a software business, so that's probably a bad idea.
Being on the cap table, definitely counts. So that will be one of the gems.
Great.
Given that you have seen so much, especially from kind of inside the brand, then running a brand, sizable agency with CTC, now running a boutique agency, like what is relative easy mode and what is relative hard mode? I appreciate that they're all hard, but there's levels to this thing.
Do you mean like agency versus brand, like in terms of like which is a better business, which side of that fence do I want to be on, or do you mean like within an e-commerce business?
No, let's say agency versus brand.
Yeah, everybody underrates how good of a business an agency can be. Except for you. You're one person who does not underrate that. You've been an interesting voice on this, and I think it's because you live your whole life in brands, and you're clear-headed about that. You've definitely been one of the people pushing me most, like, Andrew, don't go start a brand, don't do it. It's such a bad idea. And so far, I've heeded your advice. We'll see. I think that an agency is an incredibly hard business to scale, in that it requires a very particular skill set, which is clarity about a playbook. I think what makes a good agency good is a playbook. And so what you have to do is first know the playbook. You have to be able to articulate the playbook. And then you have to be able to make it better over time by measuring the inputs that are coming in from all the data you have access to as an agency and all the context you have access to. And then crucially, you have to be able to operationalize that down through people who are not you. And that is a management skill set and a operational skill set fundamentally that for me is the thing that keeps me from wanting to from wanting to grow my agency more at this point, is because I think that is just a really hard thing to do and requires a kind of detail-oriented, process-oriented thinking that's tough. But the margin in agency businesses and the cash intensiveness of an agency business, or the lack thereof, I should say, is really great. Those things can be really good, and people underrate that. People do not understand. They also has really good exit potential. Like, one of the things that is so valuable about an agency, I think, is that bigger agencies want to buy you. And that's because you can roll your services into them, and all it does is help their multiple. And also, if they're complementary in services, then it makes a lot of sense for them to buy you and then add your services to their current clients. It's actually a real synergy in a way that it's just not for an aggregator of e-commerce brands. E-commerce brands, you add multiple e-commerce brands, and all it does is get more complicated. They don't help each other at all,
Yep.
Right? So that's just a really big difference, and I think people underrate a lot of those things. On the other hand, what I'll tell you is that, like, I think a brand with great margin in particular is a cheat code in the space where it is a really good opportunity. A D2C brand with good margin is playing the game on much easier mode. And if you can do that, there's some other things that could go into it too, but I think margin is uniquely powerful. There's so much more to say about how you get good margin in the business. But if you have a major leverage point on your P&L in e-commerce and you have some skills on the growth side of things, e-commerce businesses can scale quite fast. Now, they're capital intensive along the way. You have to buy inventory. That's challenging. There's some pitfalls there, but man, and I'm bullish. I think more people are going to buy stuff online every year than they did the year before, direct from consumers. I think Amazon is a great business that's going to keep growing and is a good partner. I think it looks to me like there's a real chance that TikTok shops and then Instagram shops and YouTube shops and Facebook shops are going to be real potential customer acquisition expansion opportunities for brands that have been stuck on Facebook for a long time with a little bit of Google. I see a future where people buy more, not less on the internet, and it's a good opportunity. So I think they're both really good opportunities as long as you've got the right leverage points in them.
For listeners, Andrew's got this great podcast episode that I listened to probably a month or so back with Taylor Holiday on his podcast. Andrew, remind us the name of your podcast so people can search it.
It's cleverly and creatively titled The Andrew Faris Podcast. Yeah.
And we'll link it in the show notes. If you're interested in a very inside baseball merits of brand versus agency and boutique agency versus scaling agency, it was a fascinating listen for me, and I'm sure
If you're really interested in hearing Taylor Holiday yell at me for being bad at business, that's why you should watch it. Listen, that's the actual selling point for it. Taylor and I know each other very well. The relationship is very safe, and that means when we get together on a podcast, we have no problem arguing with each other about what we think, and he's just sitting there berating me for terrible business decisions. So, it's fun.
From what I recall, there's also alcohol involved in that, so that only accelerated the berating.
Well, we've done 2 episodes. One of them, there was a little more alcohol involved than the other. The second one, we went with beer, and I think there was only one. It didn't get sloppy, I'll say that.
You would have probably one of the most unique views on resourcing growth marketing, in-house, fractional, agency. Our listeners are going to be e-commerce sellers. How should they think about it from someone that really knows the know?
Yeah, well, this comes back to what I just said about about the value of an agency, which is a playbook. So the first thing I actually just did an episode about this, and I'll point people to it, about the trade-off between agency and brand for building a growth marketing team. There's a couple of rules I would say here. Rule number 1, if you're spending less than $50,000 per month on Facebook ads, and you're talking about Facebook ads, growth agency in particular, you should not hire an agency. In general, it is not a very good, there's exceptions to this. There's times when it can work depending on goals and stuff like that. But as a general rule, yeah, learn it yourself. That's going to do a number of things for you, including the fact that the agencies just really are going to have a hard time giving a great service under that level, first of all. And secondly, it will really help you to learn some tools yourself to manage an agency in the future. This is like Facebook ads is very likely to be the largest or second largest line item on your books. It is good for you as the CEO to understand how it works. It's just too big of a cost in your business to set it aside and hand it to somebody else completely. So there's that. Secondly, I would say at some point, the value of an agency is a playbook, like I said. And at some point, an agency service can be incredible. What the miscalculation many people make is that they believe that an agency is necessarily more expensive than in-house support. I think that's wrong. Even an agency that is charging a decent amount of money very often is actually not more expensive than an extra. When you factor in the time of hiring talent, when you retaining great talent in-house, which usually comes, that means like bonuses, that means equity sometimes in the business, it can be extremely costly to hire that person. So there are great reasons to hire in-house. I'm not an agency only guy, but ultimately I just think people make a miscalculation there a lot. And so for me, it's like find the best people and the best playbooks you can and get them applied to your business, and do not shop this primarily on price. Instead, shop it primarily on getting the best talent and the best ideas applied to your business. Sometimes that looks like an agency. An agency is much better structured to build a playbook than an individual person. So if they can actually articulate and then operationalize their playbook, you should consider hiring them. As for an in-house person, yes, they can definitely put more time and effort and more personal care into your brand. That can be really, really valuable too. And if you can find a superstar who is really good on this area of the business, they can create a ton of value for you, because this is such a unique, again, it's a huge cost in the business. And so it's a unique way to drive a huge amount of value in the business as well. So yeah, for me, it's like go find the best possible people. Look for really clear principles and playbooks. That would include things like great economic principles, financial principles that are undergirding the strategy, tying that in some way to inventory and some of those things, good forecasting of the business. And then if for Facebook ads particularly, high volume of creative run through manual bids is at this point a non-negotiable strategy in my view.
There would be so even some of the other guests on this podcast so far who have used agencies and been happy with them have said you need to speak to the account rep on doing the actual work. Is that a fair call out? And because the rub of often agencies is you get to speak to someone really senior and someone really strong and experienced until you sign the contract, and then you get the 23-year-old on training wheels.
Yeah, what you're describing there is the operationalization. Oh wow, that's a mouthful of the principles, right? So the key is that the person actually doing the work can actually do the thing that the senior person does. Sometimes you suss that out by talking to them ahead of time, but listen, that the person who can do that is not going to last on your account for that long in most cases. Sometimes they are, because that person that we just described is extremely talented, and extremely talented people who can grow businesses have massive amounts of demand in the market, and there's not that many of them. There's a low supply. And that means the price of them goes up over time. And at some point, they're going to go find other opportunities unless the agency is uniquely able to give them opportunities. And this is why I say, like, it all gets more expensive. And why if I was shopping an agency, what I'd really, really, really look for is tools and systems that are replicable. That's what I would look for most. Or some kind of guarantee that this person is not going to be on the account. There's some things you can do if you want. Like, you can often build a clause into your contract where you just say, like, hey, if fan buy is not on my account, I'm no longer going to, I have an opt-out. I'm allowed to leave. I have a 30-day option period or something like that. Like, you could do some of that, and a good agency often will do that. And that doesn't mean you have to leave. It just means you have the option to if you want to see what they replace you by, whatever, if you don't want to get locked into a contract like that. But really, really what you're talking about is operationalizing those principles, and the best agencies do that excellently. And that's what I would look for.
So, Jacob, Andrew here talks about his very experienced view on whether to use an agency or stay in-house for marketing. Now, resourcing for e-commerce touches almost every corner of e-commerce operations. And e-commerce operators have this decision around whether they want to run payroll for full-time employees or whether they want to use independent contractors. How does that work from a financial statement perspective?
So regarding 1099s, contractors versus employees, just a couple of general notes regarding payroll. First of all, I've seen lots of financials where people kind of just throw all of payroll into one line, put that in their operating expenses. So it's worth being aware of the fact that there's different kinds of employees in your company, and they might actually belong in different parts of the P&L. If I have an employee who's involved in R&D, in certain circumstances, it might be an R&D expense. It might actually need to be capitalized under the TCJA rules, at least until those rules are repealed, which they might end up being. If I have an employee who's involved in the manufacturing process, they might actually be part of my COGS. That might be capitalized, might be expense, depending on where exactly they belong. But it's just worth being aware that not all employees are just part of my operating expenses, but it really depends on what they're doing. Number two, it's a really good idea just for visibility purposes to separate the departments of your employees. I mean, we said before, manufacturing and R&D, but even other departments or whatever, however you divide your company and you view things, if you have payroll expenses per department, it gives you a much clearer vision onto what you're spending per department, and also much easier once you're forecasting to know how much you're allocating to each specific department of your company. So that's just a general tip of how to manage payroll in your books. And more generally, obviously, there are advantages and disadvantages of 1099 employees versus W-2 employees. There's the whole payroll tax issue, which would be applicable if you're paying a W-2 employee. Altogether, it's 15.3% generally. Part is on the employer, part is on the employee. The 1099 contractor might already take that into account. They'd be more expensive. If the contractor does make $600 or more, you're going to need to file a 1099 form. That's where the name comes from. There could be various other compliance issues, and obviously general labor law, just questions of which would be more appropriate for your business and how committed they are, how long-term they are, etc. That's just a few general thoughts about payroll.
To go on a tangent just for a minute, given the undersupply of high quality marketers, look, I imagine the tech ecosystem is multiple orders of magnitude bigger than the e-commerce ecosystem, but there are multiple vocational coding camps for software engineers. And maybe Growth Assembly does this. Maybe there's some niche ones doing why is there no media buying training school if there's so much demand and so little supply?
This is a good chance to plug Admission from Common Thread Collective. This is where I send everybody for exactly this reason. That sub 50K group that I'm talking about, who's sub 50K per month, what I tell everybody who hears my content and slides into my DMs and says, Andrew, my account has X, Y, and Z problems. What do? I say, I don't know. I can't look at your account, but I can tell you who can. Go to Admission. There's a combination of courses, community, and coaching, and you should go there. And I'll send you the link, fan, in the show notes. You get free coaching if you go through my link. That's what you should do if that's what you want, and you will learn. I mean, it's actually remarkable. Like there is an incredible amount of free content out there for how to do this. And then there's actually extraordinarily well-structured content from Admission, which in my view is the very best quality of information presented in a way that's digestible and in a community as well. So it's the closest thing to what you're describing that I'm aware of. And it's what I would send people to.
Amazing. Andrew, as we head towards a wrap here, a couple of fun questions. What's in the Andrew Faris e-commerce content diet?
Oh man, so little. Can I be honest with you? This is another thing about me. I am just not that ambitious in terms of building a very big thing. And I'm not like, I love the job that I do. It's so fun. But when I hang it up, like, maybe all I'm saying is that I have a 2-year-old and a 4-year-old, but I think this was like, which I do. And just is like time wise, it's just what eats up my time, but I just don't consume that much of it. I think Twitter is probably really the answer. Like it's mostly almost everything I have is from there. And that's it. I'll occasionally hit an episode here and there. If I'm going to listen to anything, it's e-commerce playbook with Taylor. Because in my view, he's just the brightest mind in the space. So
yeah.
I remember one of them anyway. I don't know about the very brightest, but yeah, e-commerce playbook's great. Yeah.
Amazing. You've been in e-commerce for a while now. What would you tell your e-commerce operator self from 10 years ago when you were getting started in industry from what you've learned?
Okay, every time I'm tempted to answer this question, I think the right answer is to essentially reject the premise of the question. And in the sense that I just don't think there's a substitute for reps. My ability to handle client relationships now compared to when I started an agency, I think about on my first batch of clients I ever had, right? So this is like 2 years in e-commerce. I had a monster of a client. This guy was just horrible. And then I had another one, later or whatever. I had 2 sort of all-time monster clients. In both cases, those relationships would just not be the problem today for me that they are now. It's just because I'm a lot better at like knowing how to deal with those side of things. And there was no way to get to the other end of that besides going through those experiences. So I suppose the answer is get the best quality of information you can to speed up the actual information side of things. That's where something like Admission I think is just like so valuable. Listening to a podcast like this with you, like you, Fan, or like the kind of person I talk to, because I get real insights from. I get good thoughts from it. It's like, if you can get people like you, I mean, your Twitter account and your analysis of like what's happening in the market is like real education for me. So that stuff speeds up the education side, but there's almost no way I think to speed up the rest of it besides taking the reps. So I guess if I had to say one other thing, it's spend more time thinking about the size, the opportunity itself than just doing the work. Same amount of leverage applied to a bigger opportunity creates a lot more of a bigger outcome, and it's the same amount of leverage.
Yeah,
Half answer. Sorry.
No. Makes complete sense. And yeah, opportunity selection. It's
it's so hard.
Andrew, I know that you love all your children the same and you love all your clients the same. But something fun for our listeners to close on. If there was a product from one of your clients' suite that our listeners should check out, maybe for the holidays, what's your favorite one and why?
Easy answer. Yeah, well, it's one I can't actually use. It's Mixed by Nazrin. Nazrin Jafari, who I've had on my podcast a few times, is a designer in Brooklyn. And if you are a lady or have a friend who is a lady or a spouse who's a lady or something like that and are interested in really, really cool designed products from an aspiring and growing designer, I just think the world of Nazrin. I think the world of her process and her as an operator. I think her designs are unique and cool. I don't know anything about the women's fashion space at all. I mean, it's just like couldn't be farther from stuff that I'm paying real attention to. But I just admire her and what she's building so much because it's a strikingly difficult world, and like the sort of creative act of designing things that people are going to wear around is so cool to me. So that's what I'd say. Mixedbynazrin.com, Nasrin. So yeah, my wife, wears one of her jumpsuits and loves it. And so it's really cool. The truth is I actually only pick clients whose stuff I like. And there's some that I would love to tell you about that I probably can't. But this is like the nice thing about being 10 years into an e-commerce career is that I have the opportunity to only work on products that I believe in and like, and with people I believe in and like. And so I really do like all of them.
Andrew, always so fun to catch up. So much thanks for you and the time. And anything else that you want to plug as we wrap?
AJFgrowth.com for pretty much everything I'm doing. And if you go AJFgrowth.com/podcast, there's a bunch of stuff there you can see and all that. It's probably the best place if you like this to find more of me talking about, Facebook ads and growth strategy and talking with some other people in the space.
One of my favorite topics on your podcast is when you do the deep dives,
Opening the books.
The open books. And I remember listening to the Eric Van Holt's, so strong recommend to the audience.
ajfgrowth.com/beardbrand. That's like, those episodes are like a couple hours, and we when sometimes an operator will like actually show me their full Facebook ad account and let everybody else see it too, and talk through. It's like, if you want like a basic sense of how I build ad accounts, that's probably the best place to start. Is that episode, ajfgrowth.com/beardbrand. And you see his actual ad account, you see his cohort tables, like you see all kinds of stuff. So it's cool.
Amazing. Andrew, thanks so much.
Thanks, Fan. Appreciate it.
Thanks for listening to Margin Talks by Finaloop. Don't forget to like and subscribe on the channel you're listening to. If you have any questions or feedback, feel free to email me, fan@thehedgehogcompany.com. And if you'd like to see what Finaloop can do for your e-commerce business, please visit finaloop.com. We'll see you on the next one.